Afternoon, everyone. Matt Pfeiffer here with Celebrity Home Loans, and thanks for taking a moment to join me here today. I decided I wanted to put a video together to address a real hot topic over the course of the last few months. This is something that I am having conversations with clients and prospective clients on a very regular, daily, and ongoing basis. So I decided to do a quick video to bring some clarity to what exactly it is the Fed is doing when you hear the news that the Fed has raised interest rates. So, first and foremost, what I want to show you here, real quick, is what the Fed is doing is raising what is known as the federal funds rate. Now, this is a short term interest rate. In and of itself, the federal funds rate is basically an overnight bank to bank lending rate that is amongst institutions that are banking entities. However, what that does is it trickles down directly to what is known as the prime rate. So this is an historical chart of the prime rate going back to around 1975 or so. And you can see over the course of the last couple of months, we are seeing the prime rate move in an upward direction, which is now currently sitting at 5.5%. And this is a direct result of the Federal Reserve raising that federal funds rate. Now, the spirit of why they are doing this, okay, is this prime rate is going to influence consumer loans, credit cards, and home equity lines of credit for anybody that has one of those in place against a residence at this point in time. So the spirit behind this is, since this is viewed as short-term borrowing in terms of anything tied to the prime rate, they are striving to bring down inflationary pressure by raising this rate and making short-term borrowing costs more expensive. So they're essentially making people, or striving to make people, think twice about whether they need to make a given purchase, whether it is a household good or an appliance or a vacation. The types of things that would normally be put onto a credit card or maybe an equity line of credit being used for that purchase. So by doing that, and reducing consumer spending in the marketplace and ultimately reducing demand on goods and services, historically speaking, what this is going to do is bring down the rate of inflation that we've been seeing throughout the first, 3 quarters of this 2022 calendar year. Now, historically speaking, and I will just preface this by saying there are many other variables that are in place right now and taking place right now that make looking back at history and using that as a basis to project and look forward essentially more difficult than it has ever been, just between the situation between Russia and Ukraine, anything pertaining to the pandemic or COVID, news coming out on that, along with just a variety of other economic factors and things that are taking place right now. But by historical standards, okay, if we go ahead and take a look at this pattern of activity that we have seen in the past. So if we go back, and this ultimately was in the early 80s, inflation was sitting at around 7% and ended up moving up to 14%. In conjunction with rising inflation, which is one of the arch enemies of a mortgage-backed security as an investment. So when you see inflation moving in an upward direction, you are normally going to see mortgage interest rates moving in an upward direction as well. Please understand, the Fed is not raising mortgage rates. There is no singular entity that controls mortgage rates. Mortgage rates are driven by how mortgage-backed securities are traded on Wall Street. So just like a stock, there's going to be days where there's buying demand on those, and there's going to be days where there's sell-offs on those. And depending on investor appetite for either stocks and a higher risk rate of return, as opposed to U.S. Treasuries and mortgage-backed securities, which is a lower rate of return but more conservative without jeopardizing principal, you're going to generally see that when inflation moves up, so do mortgage rates, because inflation is eroding the return that you are getting on a fixed return type of investment. So going back to this chart, When inflation moved up by these 7 percentage points, you can see that mortgage rates moved up almost in lockstep from 12 to 18%. At the time, they went through a series of rate hikes and they moved the federal funds rate from 11% to 20%. The result of that on inflation was it brought it from 14% down to 5, and mortgage rates in response to this reduction in inflation moved from 18% back down to 12%. If we look at a period of time during the Greenspan years when he was at the Fed, much smaller numbers here, but the same principle applies. So we have inflation was sitting at around 1.75. It had moved up to 3.5. At the time, mortgage rates were around 7, and they moved up accordingly, and they moved up to about 8.5%. The federal funds rate was increased from 4.75 to 6.5. The response to inflation was it dropped from 3.5 down to 1. And we saw the response on mortgage rates as a result of this. They moved from 8.5 down to about 5.5%. So this was a chart that was put together at the very end of 2021 with some projections looking forward into 2022. Unfortunately, as far as this particular chart goes, these numbers are already lower than what reality is, but we are just in this pattern again. So we've seen inflation move from 1.75 up to 7, and at this point it's higher than that. So mortgage rates had moved from 2.5 to about 3 3/8, and since this was more of a projection going forward, this was off by about a good 3 percentage points, with rates getting into the mid to upper sixes. The federal funds rate, we had been at 0%. Initially, folks were thinking that that might have to be increased by 1 point throughout 2022. We have already, surpassed that. The response on inflation, it should drop by these actions the Fed is currently taking, and we should ultimately see over time mortgage interest rates start to move in a downward direction as we start to get a grip on the inflation numbers. All of these periods of time were ultimately followed by a recession in terms of the historical references here. So it is, highly likely, if we're not already technically in one, it is likely that we are going to get to a point where it is announced that we are in a recession, even though that hasn't necessarily taken place as of the date of this filming. So if you ever have any questions or you need any clarity on anything pertaining to the mortgage market or local real estate here in Lee County, Florida, never hesitate to reach out. Thanks for taking the time to watch this video, and I truly hope this brings some clarity as to what exactly is going on as far as what the Fed is doing as that pertains to inflation and then correspondingly to mortgage interest rates. Make it a great day. Thanks again for watching, and I look forward to chatting with you soon.